New inventory is up to a new post-pandemic high of 3 million units. That is up 53% against last year. New days supply is roughly 45 days, roughly 80% higher than the same time last year. And the used day supply is up 14% versus 2019. Inventory's up, and it's up big.
One of them, one of the largest Ford dealers in the state of Texas, and one of them, one of the bigger Ford dealers in the state of Michigan, got some information about the inventory offerings that were brought to them just at the first week of August. And they were massive. And nearly all of the inventory offerings that were given to both of them were turned down. We're talking all the vehicles that they were dying for only a year, 2 years, 3 years ago. All the Super Duties, F-250s, et cetera, turn them down, turn them down, turn them down. And from what I heard from one of the Ford dealers was that when they listed the type of inventory that had extra allocation, there was not a single model left off the list.
Let's look at national vehicle sales. Now, since the CDK outage, that did impact the industry over the last couple of months. We have started to see new retail sales start to rebound, but we're still not getting back to that prior trend and what is really normal for this time of the year. Against the same week in 2023, sales were actually down 15% lower. And again, there remains more ground to cover for us to get back to normal. And we have a beautiful graph to show the relationship between inventory to sales. So James, take it away.
We expect inventory levels to rise as the manufacturers try to stuff inventory onto lots. This is a long-term chart of the inventory to sales ratio, and it just kind of outlines really the COVID effect of there not being any inventory on lots. And we have now returned to approaching a normal level, which is, over the last 20 or 30 years, been about 2 times inventory to sales. I would check the trailers when they come in to make sure the manufacturers didn't sneak an extra car on there this year.
We're sitting in this position where it seems, Phil, going to your point, factories have pulled back on all these incentives. And the consumer, the word I used yesterday is stretched out or stretched thin, right? And then when we go to last month, going back to pre-pandemic versus when we got an injection of money into the market, into the economy, and then now where we're at now, you said something earlier in the call, which I think was really important. You talked about the fact that this could be a consumer recession versus where manufacturing, et cetera, is at. My hypothesis there is this. Based on what I saw during COVID, the money rose up very quickly. People that made money made a ton of money, and middle and lower income didn't really do any better whatsoever. That was my observation based on all of our experience and the information that I've read. Now, you have these businesses and these business people that made a lot of money. And even if they did well in savings and all of that, they're spending a lot of money. And again, James, I'll probably want your feedback here. They're spending all this money building infrastructure, thinking that almost in this like perma bull mentality. It's like, we got to keep building, we got to keep the momentum going, right? Well, if the consumer has a recession, it pulls down all of this. Of course, these guys would have to go first. The consumer would have to feel the pain first. Again, this is my observation. The consumer would feel the pain first. It would then pull down. And what I would think is if I overinvested, if I overbuilt, such as, institutions and talking about manufacturing, if I overbuilt and overspent and overinvested, well, now I get pulled down much faster than the consumer. The consumer starts to pull me down, and then all of a sudden out of nowhere, once they stop spending money because they've been stretched too thin, boom, the bottom drops out.
Prior recessions have been in a low inflationary environment. We may actually have growth in the economy, and we just won't have real growth. So our growth rate will be something lower than inflation, but it's possible to have a recession where numbers keep going up. And usually when you have a recession like that, it's the consumer that takes it on the chin. So if we do drop into a recession here this year, it will probably be a consumer-led and a consumer-focused one.
On behalf of my wonderful colleagues, James Sivko and Phil Trebetowski, my name is Steven Dragella. We will see you next month on the Automotive Market Minute. See you.